Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. China's stocks fell the most in 4 years on Monday after the central bank signaled it will maintain efforts to curb speculative lending, and Goldman Sachs warned that a cash squeeze is hurting growth. The Shanghai Composite Index declined 5.3% to 1963 at the close, the biggest loss since August 31, 2009. A gauge of financial companies tumbled 7.6% for the biggest loss among industry groups after the People's Bank of China, the central bank, said there's already a reasonable amount of liquidity in the financial system and urged banks to control risks from credit expansion. Due to what they see as a liquidity crisis within the banking system, Goldman Sachs and China International Capital Corporation cut their 2013 China economic growth forecasts. Daphne Roth, Singapore-based head of Asia Equity Research at ABN AMRO Private Bank, said that the market fears the government and the PBOC want to really continue with the reforms, and a lot of these smaller companies and smaller banks may not survive. Roth said that what is good for the economy in the longer term may not be good for the market in the shorter term. Stephen Green, head of Greater China Research at Standard Chartered in Hong Kong, echoed many analysts when he said that policymakers' willingness to allow a prolonged cash crunch this month signaled a fundamental shift in attitude from Beijing. Analysts said they had suspected that Premier Li Keqiang would want to drive significant reforms, but underestimated, however, his apparent willingness to make policy choices that would risk putting further downside pressure on the economy. Chinese equities have slumped after entering a bull market in February, with losses accelerating this month after preliminary manufacturing data showed a contraction and on concern surging money market rates will deepen the slowdown. The Shanghai Composite has fallen 19% since February 6th. While money market rates fell for a second day from all-time highs, the overnight repurchase rate between banks of 6.47% was more than double this year's average of 3.09%. China's central bank rarely explains its actions in public and keeps markets guessing on policy, but the angst created by the standoff with banks and the money markets is prompting calls for it to change tack. The PBOC let short-term interest rates spike to extraordinary levels this past week as it refused to inject funds into money markets. Some observers saw it as an attempt to force banks to stop channeling money into the informal banking sector known as shadow banking, which authorities worry is creating significant credit risks. For years, the central bank has made stability its watchword, which for the money markets meant it would always provide liquidity when cash conditions tightened. As the central bank is now standing back while banks scramble for cash, markets are left uncertain as to whether there has been a fundamental change in policy. The People's Bank of China said the nation should appropriately fine-tune its policies. It's the first time since September that the panel, led by Governor Zhou Xiaochuan, has used the fine-tune phrase, suggesting officials are more open to loosening policies. Yiping Huang, chief economist for emerging Asia at Barclays Capital in Hong Kong, said the cash crunch shows policymakers' determination in that they're willing to impose some near-term pain for long-term benefits. Huang said officials are preparing steps for liberalization and for better market discipline. It does appear that Premier Li Keqiang signaled a determination to stamp out speculation funded by cheap money, with a state council statement last Wednesday saying banks must make better use of existing credit and step up efforts to contain financial risks. You're watching Biz Wire on the Blue Ocean Network. Stay tuned for more in Economic Insight.